So the last step for Workday will be to calculate the beta unlevered for the company. Remember, the last 4 years, the data will come from your finance, and for the fifth year, we will be using company's own financial statements, and revenues and EBIT numbers are also used to get the approximate value for the operating leverage throughout the years. So we calculate first change in revenues and change in EBIT. Here I actually underscore the point that you need to be mindful of negative EBIT years when you are calculating the change in EBIT, because there are years actually in which Workday was recording losses. And then based on the formula change in EBIT divided by change in revenues, you can calculate the operating leverage for Workday. And of course, debt to equity, total liabilities divided by the total stockholders' equity. We have these values, and then we calculate the average debt to equity ratio. Tax rate was 21%. Beta levered value will come from the regression analysis on the previous slides, and based on these values, you can calculate beta unlevered using this equation. So, but beta unlevered will be equal to beta levered divided by 1 plus 1 minus tax rate, this value, and then debt to equity ratio will be the average debt to equity ratio, so this value. So then you have this beta unlevered for Workday, and firm value will be again the summation of total liabilities plus total stockholders equity. Actually, this is the total value of assets for the company. So then we will arrive at the last step, uh, levering the unlevered beta of comparable firms. So these are the beta unlevered values for all companies, Workday, Adobe, and Salesforce. And we have also firms' values in terms of their asset values, book values. Here, you can just calculate the average unlevered beta. So these are three values. You can just calculate the average. And remember, your startup's debt to equity ratio was 0.45, tax rate was 21%. And in an alternative method, we can also calculate each firm's weight given their asset values. So for example, you can add all these firm values and then calculate the weight of each company. So this value divided by the sum, this value divided by the sum, and this value divided by the sum. So you have each firm's weight with respect to their asset values. And then, of course, you can calculate the unlevered beta. So here we just use the average, but here we can also calculate the unlevered beta. In a way, we will be using the weighted average method. So based on these weights, this weights will be multiplied by the unlevered beta of each company. Then you will have this value. Actually, it is similar to the average value calculated above. Then here, your startup's levered beta can be also calculated by using the average. So we have this average value. Remember, this is the unlevered value. So this average multiplied by 1 plus 1 minus tax rate. Tax rate is 21%, multiplied by your firm's debt to equity ratio, which was 45%. Or you can just use the unlevered beta weighted average based on firm value. Sell the value in here. So here beta unlevered, this value multiplied by 1 plus 1 minus tax rate and multiplied by the debt to equity ratio. So this is your startup's levered beta using the weighted average. And of course, we can also use CAPM if we actually know things about the returns on the stock, required return on the company's stock. We have risk-free rate, we have equity risk premium, and required return on your company's stock, which was given as 15%. And we assume that, of course, CAPM holds. So based on these input values, you can calculate the beta of your company, which is 1.88. So this is actually very different from all these two values. So here actually for this calculation, you can see slide 240 because I followed the same procedure as that I followed in that example. So we have three different levered beta values for your company. One by using the average unlevered beta, one by using the weighted average, and one that was calculated by using the CAPM. And also, I also want to look at the operating leverage as well. Remember, we calculate the operating leverage by calculating change in EBIT divided by change in revenues. So this is the approximation to calculate the operating leverage. We already calculated these values on the previous slides. So the operating leverage is not stable for Workday and Salesforce. Adobe has a more stable operating leverage in relative terms. Also, the magnitude for these operating leverage values varies across the comparable companies. So companies are actually very different from one another. This is a picture perfect example of why bottom-up beta method can be misleading. Nonetheless, because the company in question was a private one, the method still provides an additional estimate, which of course deviates so much from the value gained through CAPM. So bottom-up method gives the opportunity to compare the result with that of the CAPM method. So think of it as an additional estimate so that you can compare the value that comes from CAPM and also the value that comes through the use of bottom-up beta approach.